Well, Tariff Day has arrived here in Canada, March 4th. Next Wednesday, on March 12th, we get the next Bank of Canada announcement. And given that we are now in a tariff war with our partners to the south, it's easy to argue that the Bank of Canada is going to be cutting interest rates next week. Whether or not they cut 0.25% or a full 0.5% is yet to be determined. The other thing to keep in mind is that this is a very volatile situation. These tariffs could end any day. So it's very hard for the Bank of Canada and other central bankers to come up with monetary policy when we are in such a volatile, fluid situation. And same for you trying to plan your mortgage or your personal finances. And I think you need to keep that in mind when making any major decisions right now, that this could end tomorrow. This tariff war could end tomorrow. And when I think about my investments, I'm trying to keep that top of mind. I'm not trying to completely change the whole strategy of my investments because this all could change tomorrow. But at the same time, you also have to be aware that it may be with us for a while. And if that is the case, the economy, the North American economy, is in for a serious reshuffling and not for the good. So keep that in mind. I think what you're seeing already is some of the more high risk investments, they're getting whacked hard. Just look at Tesla, look at Nvidia, look at Bitcoin. There's a bunch of names that are getting hit hard. One that is more specific to mortgage rates in Canada is the 5-year bond, and it is starting to collapse, which means that fixed rates should move lower if this continues. And you can see here in the charts, here's one zoomed in, and then as I go along here, I'll zoom out farther. And if you look at the 5-year here, you can see that it's on the cusp of moving substantially lower. So if the Bank of Canada does cut interest rates by a full % or more over the next number of months, this 5-year rate should move lower as well, as long as inflation expectations remain anchored. If they become unhinged because of trade war or tariff war, then the 5-year may not move substantially lower, but the variable rates will, because they follow the Bank of Canada overnight rate, and it is expected to move lower. I did a deep research project on this topic using Grok and OpenAI's technology, and funny enough, historically during tariff wars, we end up with stagflation, which longer dated rates can stay the same or move higher actually because of inflation. The overnight rates tend to move lower at some point, but they can also spike higher as well as the central banks move to fight inflation. But interestingly enough, I asked it to focus on Canada specifically, and both of the platforms came back with the answer that they see rates moving lower meaningfully. So those of you that have large mortgages, you can expect to get some relief here in the next few months if this trade war continues. But whether or not you still have a job is the bigger risk, because there's probably going to see a spike in unemployment as a lot of manufacturers and companies that ship south have to lay off people, unfortunately, because of this tariff war. So anyways, we are in very interesting times right now, but with regards to your mortgage and your investments, I would deleverage some high risk stuff, but don't make any drastic changes that are going to cost you in the long run, because this all could end tomorrow. And with regards to going fixed versus variable, I'll do another video on that. But if you're up for the volatility and the risk of it, variable makes sense. If you can't stomach it, stick with fixed for now. Take care, everyone.